Hello listeners, I'm your host Rahul Sethi. I welcome you all to our next episode of Edelweiss FinTalk. In this podcast series, we discuss popular topics related to finance, where we call in distinguished guests from the financial industry. So here we are again with Mr. Anil Ghelani on our second series of active investing versus passive investing podcast. Welcome Anil once again for this podcast series.
Thank you.
So, the first one was very insightful. We move on to part 2 of the same discussion. So let's start with understanding passive and active investing in India. So in an emerging market like India, is passive investing popular among investors?
My view on this is that yes, in emerging markets like India, there are a lot of opportunities to beat the benchmark and generate alpha. Hence, it has been a little slow to gain popularity. However, I think that in the past couple of years, it's becoming much more popular and I think it will just continue. However, the arguments for passive investing gaining popularity might be different. So what I mean by that is, in many of the global markets, let's say US market, the potential for an active manager to outperform the benchmark has reduced significantly. However, in India, I feel it is still there.
Okay.
So in India, what will drive the popularity is just the simplicity, ease of explaining, slightly, if you look at it, lower cost. So those are the things which will drive. On the other side, globally, the ratios of funds outperforming the benchmark might be skewed. But in India, if you look at slightly long-term data, like about 5 years, 7 years, 10 years data, which is typically a time period for investing in equity market, about 50% of the funds would have outperformed the benchmark, 50 would have underperformed.
Sure.
So it's like a still flip of coin, but yes, at least 50% probability is there that if you consult a good advisor and she or he has gone through entire process, analyzed the fund manager's capabilities and the process the fund manager follows and suggested some actively managed funds, there will be reasonably high level of chance to outperform the benchmark.
Okay. So where do you see India in terms of active versus passive investment in the next 3 years? If you look at next 3 years as a window.
In the next 3 years, I am very, very positive about the growth of passive. Why I say that is that today, majority of the investing community in India still needs awareness, still needs to be told what a mutual fund is, what an active fund is, how to invest, after that how the return and risk outcome should be positioned, where a role of a good financial advisor comes into the picture. So for the next layer of investors to be investing in mutual funds, may be simple to understand, easy to invest type of products like a passive index fund would be the key driver. So today, let's say in the mutual fund industry, there are about 2 crore unique investors. But the total number of people who are filing, let's say, their income tax returns as per the last year official data is some 6.84 crore people.
Okay.
So that means there's a huge
gap there,
that they are filing income tax returns. Some amount of capital they are generating might be they can be converted to start investing in mutual fund, and maybe the first port of call can be simple to understand, easy to relate to. That okay, you see today newspaper that Nifty has gone up in the last 1 year by let's say 12%. So this fund has gone up by let's say 11.75 or 12.25, very close to the Nifty or to the broader market. So investor also feels very comfortable. Yes, this is I can relate to it. I can understand. Then gradually one can increase their involvement into other areas.
Okay.
So in the next 2 to 3 years, 5 years maybe, the whole penetration of enhancing the investor base can be driven by this type of a low cost, simple to understand index fund, passive funds.
Sure, got it. So you think passive can play a good role in getting new to market users?
Absolutely right. Absolutely
onboarded.
Right. Yeah,
okay.
Yeah.
I think that's a very interesting thought. So what do you think once now there is a direct mutual fund option, as well with the investors. So we have a direct mutual fund in passive as well, where your expense ratios still go down further?
Yes, in any mutual fund, whether it's a passive or active, if it's structured as a mutual fund, we always have a direct plan and regular plan.
Okay.
So even in an index fund, there will be a regular plan
and a direct
and
plan.
Slightly lower cost direct plan. In case of a passive fund that is structured as an ETF, that is an exchange traded fund, then there is no different plan because ETF is traded like a stock.
Okay, got it.
So that stock has a one single price and it keeps trading that way.
Sure.
But in an index fund, which is also similar passively managed strategy, there will be always regular plan and direct plan. So the advisory community or the distribution community will always have both options to be available, where even, of course, the regular plan itself is low cost, and they can continue servicing the investor, guiding them in a proper way, making sure that the investor's decisions to enter, stay, hold on, reduce their exposure, etc. can be guided in a very good way to the investor.
Sure. And basically in terms of your SIPs and all those things are equally possible in both active and passive.
Yes, absolutely right.
So you can have the compounding benefit even in passive and play around market volatility even in passive
Even in
funds.
passive funds, yeah. Again, over there, only to distinction is that within passive funds, as we spoke earlier, there can be two varieties. One is a exchange traded fund like a ETF.
Sure.
That is quoted and traded on the stock exchange. So there it's not possible to register a SIP.
Okay. Also there you can't do an SIP.
You can't do an SIP. Or you can do it on your own. If you remember, on the 1st of every month or 15th of every month, go to the log into your trading account or call your broker and say, buy my number of units. So that little bit changes the investment experience of a true systematic plan. Whereas if it is a structure in the form of an index fund, then it's not exchange traded, but it's on a normal platform. There you can register upfront that, okay, I want to do SIP every 15th of the month. And then you don't have to remember. By default, the mutual fund provider on the 15th will trigger the amount, draw the amount from your bank account or whatsoever is their source, and keep your investment SIP going on.
And in terms of the tax treatment, LTCG, both are treated equally.
Absolutely, both are same. Yeah.
Got it. So thanks a lot, Anil. Any last minute advice, for our listeners?
Sure. I read a book recently by one of the ex-CIO of a large wealth management outfit globally. And a very beautiful message was given over there that investing should be about meeting certain goals, certain objectives, and you should try to meet the market. Don't look at trying to beating the market. If you do that, you are trying to focus on identifying the next star fund manager or a star hedge fund manager who will try to shoot the lights out and beat the market. And some point of time, equal opportunity chance is there that he will not be able to beat the market. So instead of that, your first objective should be keep allocating funds for your long-term goals, objectives, and for that simply meet the market. And as we spoke earlier in the session, that the best way to meet the market is simply invest into a low-cost passively managed index fund. Do a SIP, do a lump sum, whatever might be your requirement as guided by your wealth advisor, and just keep allocating money.
Got it. Thanks a lot. So I think it's a very valuable advice. Meet the market rather than trying to beat the market is the mantra for you. Thanks a lot, Anil, for your time.
Thank you, really appreciate, and it was great to be on the FinTalk podcast.
Thank you guys for patient listening. So here we come to an end for this podcast. Stay tuned. We have some interesting topics coming in the subsequent weeks, and we look forward to your feedback. You can suggest topics and we'll try and cover them in the next episodes. Thanks a lot.
The details and investment tips expressed by the expert in the podcast are his personal views. We advise you all to check with your certified financial advisors before taking any investment decisions. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.